Coming up in today's show, stocks finish mostly higher as inflation comes in a little higher than expected, what this means for the Fed's fight against inflation, the market's response to the new iPhone, and the cyber attack that shut down a large portion of the Vegas Strip. Hey everybody, welcome back to the Click Capital Daily Market Show. My name's Jared. I'm going to run you through all the most important news, data and charts from the markets today. And even though we did have the S&P 500 and Nasdaq finish higher today, it was a pretty skinny rally out there. And you can see on the heat map here, it was mostly led by the mega cap techs, all having a pretty good day, and we got that bounce back in Oracle. And Apple was really the only one that came off, which I'll get into in a bit. And we saw a bit of a pullback in energy. And apart from tech, the winning sector today was utilities. So a bit more of a defensive rotation, as I've been talking about the last couple of days. And before we get stuck into today's show, just a quick reminder, there's only 4 more days left on the special offer I'm running this week to get all 22 of my custom indicators for TradingView and save over 50% off the normal price. To learn more about this special offer, head on over to my website, clickcapital.io/deal. I'll put the link below this video in the description, and you can read details of all the 22 indicators that I've developed for the TradingView platform and that I use every day myself to manage my portfolios. And that includes portfolios I also manage for clients, like my Only Bears strategy on the Collective 2 marketplace, which is up over 29% since December, and now currently ranks in the top 5% of all strategies available on this marketplace. And that also includes my very popular and latest indicator, dark pool percentage, which gives you insights into what dark pool traders are doing across all US stocks and ETFs. And since almost half of all trading volume is done off exchange in dark pools, if you're just looking at regular price volume charts, you're only really getting half the picture. And the biggest traders, hedge funds, and family offices and like that, they prefer to trade in blocks in one price and avoid slippage and being picked off from the high frequency algos in the normal public lit exchanges. So following the movements of these traders gives really good insights into any stock you're interested in. And stick with me today because I'll show you some more examples of this indicator on some of the assets we cover on this daily show. So the big piece of news we're looking at today was that of the Consumer Price Index, CPI, otherwise known as headline inflation, was expected to increase at an annualized rate of 3.6%. Over the year in August, actually came in a little higher at 3.7%. And as we can see in this chart of it here, that's the second consecutive month it's actually increased after we got that 3.2% increase last month. And prior to that, we had been on a pretty linear trajectory on the downslope. And that's largely due to the recent increase we've seen in the price of oil. However, just looking at the core inflation rate, which strips out the more volatile food and energy costs, that came in line as expected at an annualized rate of 4.3%. And this is still more than double the Fed's target of 2%. So they really want inflation back below this level, and so does the stock market. And just like this article on Barron's says today, this latest CPI report shows that the Fed isn't yet in the clear. And just looking at a chart of United States inflation rate year over year, this was inflation increasing in the late 60s to a bit above 6%, similar to what we just experienced, and it had turned down in a pretty good downtrend, just like we've experienced over the last year or so. And so what the market's really hoping doesn't happen is that we don't get a 70s style uptick in inflation with potentially even a second or even third wave higher, as that would truly stun and upset the market, the cost of capital for consumers and businesses, and likely cause a big correction in the stock market as well. Just like we saw in the 70s, stock market was really weak and commodities performed a lot better. And so it took almost the entire decade of the 1970s for inflation to top out and then finally really come off the boil going into the early 80s. And around that 82, 83 is when the stock market bottomed as well, along with inflation and bond prices, which then went on to a secular 40-year bull run, thanks to ever increasing and lower rates, helping to create the everything bubble and further exacerbated by the Fed's quantitative easing programs in the mid-late 2000s. So here we are today looking at the inflation rate. We've had that big increase and big pullback, and the market and Fed is going to be wondering how much of an uptick are we going to see here, and could we potentially get that big second wave higher just like the 1970s. However, what's interesting is I've just overlaid this chart with the price of crude oil shown here in the orange line, and you can see quite the correlation between the price of crude and inflation, as crude and commodities are a big input into the economy. And we can see that correlation going back quite a few years. And so it's no surprise that the recent uptick in crude is causing a bit of an uptick in inflation here. And just looking at the price of crude, we are just sitting below $89 a barrel. Price action is looking pretty firm here. We look to be holding this recent resistance zone, which may turn into support. And just taking you out to a weekly chart, you can see back in March 2022, when it peaked at $130 a barrel. Over the next year, it came off by more than 50% and put in a pretty good technical bottom. And investors like Warren Buffett used that softness in crude to top up on energy bets. And so here we are having a bit of a bounce here and look to be putting in a higher high. And so it's possible that crude is back in an uptrend, and very possible we see $100 a barrel in the coming months and potentially test those 120, 130 areas going into next year, which should keep the upside pressure on inflation and may help to cause the jobs market turn even faster, which will then counteract to that upside pressure on inflation. So crude oil is in play now as a driving factor in the markets, and this will be one we'll be paying attention to going forward for quite some time. So the question is, what does that mean for the Fed when they meet this time next week to decide on their interest rate? Well, not much after today's price action. The market wasn't too upset at that and didn't change its mind too much by looking at the price action in equities and bonds. And we can see that as well looking at the Fed fund futures implied probabilities, with the market given a 97% chance the Fed will stay on pause next Wednesday, and the probabilities are remaining around the same as they have been for about a week now, with the market given about a 41% chance that we may get a hike in November or December. So it looks like the market and the Fed are in sync, and they're both open to the idea of possibly leaving another rate hike on the table. However, as it stands now, the market's pricing in that will be on hold to May, and then come June next year, the Fed will start cutting rates in what is likely a response to a recession. However, this could all change drastically if we see oil march towards $100 a barrel, because that's likely to cause a more immediate term effect in inflation with a lagging effect in the jobs market, and at the very least muddies the picture for the Fed, because if inflation keeps ticking up, they're going to feel the pressure to raise rates. However, the jobs market may be starting to fall apart at that point of time as well. Moving on to other news is we're still watching the market's reaction to Apple's newest iPhone 15 and their Apple Watch, and this has kind of been a key indicator for us on market sentiment and whether the market can get excited and overwhelm that bad news coming out of China and Europe towards Apple. And just looking at a bit of the initial feedback and reaction to their event, some are saying, like JP Morgan, the iPhone updates are minor, and that's kind of been a trend the last couple of years. People are feeling there's no really major updates coming out of the iPhone. It's kind of the same phone, basically overall, with just little tweaks here and there. And just looking at the price action in Apple shares today, we can see there's been a lackluster response to the new iPhone. After that gap down last week after the Chinese news and possible government bans on their state employees using iPhones, it did hold support. We did get a little bounce, however, we've pulled back the last couple of days into this kind of minor support zone around 174 a share. So I'll be looking to see whether this zone can hold here. And just looking at my new dark pool percentage indicator here, we can see it is slightly in the bullish zone at 56%, not by much, as the bullish zone starts at 55% and above, and doesn't appear to be as much buying as there was about a month ago at the same levels when we'll see the dark pool percentage indicator getting over 65%. So this will be a key level for the market, because if the biggest stock breaks down through support, we could be going into a lower low and a confirmed downtrend, and that'll make it really hard for the Nasdaq to break out on the upside. Another news out today, there's a bit of chaos going on in the Vegas Strip right now. After a large hacking group has come after MGM Resorts, you might have seen some of the videos on social media with most of their slot machines offline, the huge queues for check-in, and this is likely to have a material effect on MGM Resorts' current quarter earnings and potentially damaging to their long-term reputation as well. And this just comes weeks after the other biggest operator of Vegas casinos, Caesars, paid a ransom to cyber attackers to release their systems, and looks like now they've turned to MGM to do the same thing. And some estimates show MGM pulls in about $13-14 million a day in casino revenue, and apparently they've been shut since Sunday night, with some of their hotels having to do check-ins by hand, some payouts manually, and even now as I speak, when you go to the MGM Resorts website, you can't even book anything with them. Their website is currently offline. And just looking at the price action in MGM today, doesn't seem to be reacting all that hard, although we are down a bit from where we started at the week, a bit above $44 a share, and only off 1.2% today. There's the Fear and Greed Index still right in the middle, and Corporate Insight is still not doing a lot of buying here on this softness in the market. And just looking at my indicators for the S&P 500, we've got the dark pool percentage at 46%, and S&P 500 oscillator at 49. Both kind of right in the middle in a neutral zone here, and we can see that on the regular chart as well. Market's kind of really coiling up here on low volatility, hanging around the 50-day VWAP, and this could result in a bit of a strong move to the upside or downside when we come out of this. And there's a bit more weakness developing in the breadth across the market. We can see that in the equal weight S&P 500 coming off a bit today, and the other indices, the Dow, mid caps, small caps, and micro caps, still a bit weak here. International stock indices still really flat on low volatility as well. And there's the VIX diving after that muted reaction to the CPI report. We're now down at 13.4, and realized volatility volatility still pretty low, tracking at an annualized rate of 11.5. And option dealers are not demanding too much of a volatility risk premium here, just about 2 points above realized and implied volatilities. However, what was a bit different in the market today is it was a pretty busy day in the options market. For a Wednesday, coming in at 40.1 million contracts traded, and something we haven't seen for a while here, 53% of the volume was puts. And we can see that in the put-call ratio, jumping to the highest level we've seen in months here at 1.34. And so it appears there's been a lot of buying of insurance in the market today, even though the market didn't come off all that hard and volatility actually decreased. It looks like somebody or some bodies took advantage of that low premium to hedge their portfolios probably. And we can see medium-term breadth is pretty weak here, and a bit of a strong downtrend with 32% of stocks above their 50-day average, and continuing signs of deterioration and breadth in the Nasdaq, new lows versus new highs, 84 to 14 today. With the growth versus defensive sector spread pulling back a little bit, high beta stocks a bit more so. Have a mega cap tech is still holding up that growth versus value spread chart, and international stock indices just can't seem to find a bottom versus the American ones, still on a strong short-term, medium-term downtrend. There's inflation expectations still ticking up, slightly finding new multi-month highs today, but not much action in government bond yields, with the 2-year just under 5%. And TLT kind of flat today, still trying to find support around the $94 level. Dollar as well seems to be stalling out, just below 105, and a bit of a continued bounce there in Bitcoin. Commodities still strong, finding new year-to-date highs today, and the winner today was uranium, breaking out over 3% to fresh highs we haven't seen in over a year. And over to stock sectors, here's the cannabis ETF MSOS, which invests in US multi-state operators. Had a little bit of a pullback here today, still in this really technically overbought level, and I expect we're due a bit of a pullback in this, potentially down to that $7.30 level, where it had found resistance previously, and we'll be looking for that to turn into support. There's a look at the clean energy ETF, which has been pretty weak of late. However, we are showing a bit of a bullish divergence here on my DSI and hidden divergence indicators. And what had been a pretty good winning sector this year, US global jets, continues its strong downtrend and was a losing sector today, down 2.7% on volume. And here we can see that bit more of a defensive rotation going on into healthcare, staples, and utilities today. Was the winning sector up 1.2% on above average volume? It's just reclaimed its 50-day VWAP, and that was after we got a bit oversold last week down there. So apart from Apple, mega cap tech did pretty good today. Most of the names up over 1 and 2%. That's really what helped the S&P 500 and Nasdaq finished higher. There's Amazon breaking out to fresh year-to-date highs, but now in this resistance zone around 145. And NVDA just did its 4th day in a row closing below the 50-day VWAP. And so far this year, it hasn't managed to do more than 4 days in a row below the 50-day VWAP. So this is another key stock we'll be watching for market sentiment going forward, along with Tesla as well, and whether it can defend this gap we had after Monday's upgrade from Morgan Stanley. We did see Netflix come off a bit hard today, down over 5% on volume, after some commentary from their CFO claiming they need to get back to growth, and he doesn't see a path to profitability in live sports. Over to the meme space, and was pretty weak across the board there today, and the banks as well, having a bit of a pullback here today, with Charles Schwab unable to reclaim its 50-day. So it looks like the market's in a bit of a holding pattern here, on really low volatility, kind of really in a neutral zone here. And one could argue for breakouts in either direction. We could easily come back up and test these highs from July. Otherwise, just like Apple, we could be testing these lows from the middle of last month, and we could see a second leg lower in the market. But for now, conditions remain pretty calm. The VIX is low, credit spreads are holding up really good, and it just seems like a bit of that summer trading is continuing on. And that's a wrap for today. Thanks very much for tuning in. Don't forget to click the link in the description below this video and check out my special offer. Just for a few more days, you can get lifetime access to all 22 of my custom indicators on TradingView. All you need is a free TradingView account. Then you just come to my website, clickcapital.io/deal, enter your email address and TradingView username, check out safely with Stripe. Then within a few hours, your TradingView account will have access to all of my custom indicators, and you get all future ones I develop free of charge as well. There's no ongoing monthly cost from me or any other upsells or memberships that you need. And these are indicators that I've put in hundreds of hours developing, coding, testing, and tweaking, and that I use myself every day. And these are all the indicators you've seen me use in this video. So if you're interested in them at all, give it a try risk-free for 7 days. And if you decide they're not for you, no problems at all. We can issue a 100% money back refund, leaving all the risk on us. However, once you start using them, you won't want to do that because these are truly unique indicators you won't find anywhere else. And that's why I use them exclusively to manage my own portfolios. And I no longer use any of the free indicators that most people use. So thanks to everybody who's signed up for that so far. I've had a really good response to that, especially the dark pool percentage indicator. That's been a really popular one. And also on this page is a video where I go into detail of all 22 indicators and show you how to best set them up and use them. So that's all for today. Thanks very much for sticking with Click Capital, and I hope to see you again tomorrow afternoon. Cheers.